Put-Call Parity for European options, so that we are all on the same page when it comes to Put-Call Parity. Let us look at this analogy. At time t equals to 0, we have an underlying asset of S0. At the expiration of the contract, when it comes to an option, we would likely transact at the exercise price. Let's imagine an investor wants to protect our assets from downside risk. That means the investor wants to protect our assets from losing value over time. What type of options should you buy? Should you buy a call option or should you buy a put option? If you want to protect your assets over time, you will obviously want to buy a put option. An investor that is pretty much sure that the asset is protected over time, then the investor will be looking at benefiting from upside returns. How can the investor at the expiration of the contract benefit from upside returns? Is it by buying a call option or by buying a put option? It is obviously by buying a call option. So that means at time t equals to 0, the investor has the underlying and bought a put option. At the expiration of the contract, the investor will transact at exercise price and bought a call option. Put-call parity equates what the investor did at time t equals to 0, which is all about protecting the asset, to what the investor did at the expiration of the contract. So let's equate it. S0 plus P0 will be equals to X plus C0. S0 is as at today. P0 is as at today because the put option price will be paid at the initiation of the contract. However, the exercise price is in future, so we need to discount it back to today so that we are comparing likes for likes. Then the call option is also as at today. This is what we call the put-call parity, as the put-call parity formula. It is worth noting that the whole of this is what we call protective put. It is protective because the investor here was trying to protect our assets, and the investor was trying to protect our assets using a put option. What we have here is what we call fiduciary call. The protective put is equals to fiduciary call when it comes to the put-call parity formula. Still moving on, the put-call parity formula implies that protective put is equal to fiduciary call. What is protective put? Protective put is S0, which implies that you are going long the underlying, you are going long the asset, plus P0, and that is going long the put option. Then for fiduciary call, it is C0, which implies that you are going long the call and the present value of X, and that is the risk-free bond. Or we could say it is the zero coupon bond. Still moving on, you will want to agree with me from our discussion so far that as far as the put-call parity formula is concerned, protective put is equals to fiduciary call. And we should all agree with this formula.